Hello मेरे प्यारे students, welcome back. I know your exams are just around the corner, but please don't you worry one bit. Today we're tackling a super important and trust me, a very scoring chapter, accounting ratios. And I promise, by the end of this, you'll feel like an absolute pro. Alright, let's jump straight in with a little question for you. Imagine a company has sales of 10 crore rupees. 10 crores. Sounds fantastic, hai na? But hold on. Does that one big number automatically mean the company is super healthy? What if, just what if, it's spending 11 crores just to get those 10 crores in sales? See, suddenly that big number doesn't look so good. It's not telling us the full story at all.
So, to find out the real story, the real hallchal of the company, we need to become something special. We need to become company doctors. Yes, we're going to put on our imaginary stethoscopes and give the company a proper health checkup. Isn't that a fun way to think about it? Let's go! Now, every doctor has their toolkit, right? A stethoscope, a thermometer, all those things. Well, for us, as company doctors, our special toolkit, our diagnostic instruments, are these accounting ratios. These are the tools that will help us check the company's health from the inside out.
So what is this big term accounting ratio? Arey, don't get scared by the name, bacho. It's nothing but simple math. We just take two numbers from the company's report card, the financial statements, and we compare them. Usually by dividing one by the other. That's it. That number we get is the ratio. It's like a little clue that tells us the story behind the numbers.
Okay, so here's our plan for this health checkup. First, we'll get to know our medical tools. Then, an emergency room test for liquidity. After that, a long-term health scan for solvency. And we'll finish by diagnosing a real patient, an actual exam question. Ready? Cello. All right, first stop, the emergency room. This is for checking the immediate, right-now health of the company. In accounting language, we call this looking at the liquidity ratios. So, what does this liquidity test tell us? It answers a very simple but critical question. Can the company pay its bills today? Like right now? Can it pay the salaries at the end of the month? Can it pay the supplier who just delivered raw materials? It's all about short-term cash. Simple as that. Okay, the first tool from our doctor's bag is the current ratio. And the formula, it's so simple, beta. It's just current assets divided by current liabilities. Remember, current just means within 1 year. So assets we can turn into cash within a year, divided by bills we have to pay within a year. Easy peasy. Okay, doctor, time to look at the patient's report card. Let's take the numbers from illustration 1 in your book. We see current assets are 1,34,000 rupees, and current liabilities are 1,04,000 rupees. Okay, let's pop these into our formula. And when we do the calculation, we get 1.29:1. So what does this number mean? It's a story. It tells us that for every single rupee the company owes in the short term, it has 1 rupee and 29 paise of assets to pay it off. Not bad, right? It seems okay. Now, ideally, a really healthy company would have a ratio of 2:1. That's considered the gold standard. It means you have 2 rupees of assets for every 1 rupee of liability. Super safe! Our patient is at 1.29, so it's not in the ICU. But the doctor might say, you could be a little stronger. Okay, let's pull out a more powerful tool now. This is the quick ratio. It's also called the acid test ratio. Ooh, sounds intense. And it is. It's a much stricter test of health. Why? Because we take our current assets and we remove the inventory. The stock of goods sitting in the warehouse. I mean, you can't sell your entire stock tomorrow to pay a bill, right? It takes time. So this gives us a much more, quick look at the company's ability to pay. So, using the numbers from illustration 2, we calculate the quick ratio. And it's 0.77:1. See how it's lower than the current ratio? That's expected because we removed inventory. Now this tells us that if we don't count the stock, for every 1 rupee of bills, the company only has 77 paise ready to pay. Now I'm a little more concerned. For this test, the safe zone is 1:1. That means you have exactly 1 rupee of quick, easily available assets for every 1 rupee you owe. Our patient is at 0.77. This is, it's a small red flag. The doctor would definitely tell them, hey, you need to be a bit careful with your cash. Okay, the emergency checkup is over. The patient is stable for now. But what about its long-term health?
Is the company strong enough to survive for many years to come? That's what we check with a long-term scan. And in our world, that's called solvency ratios.
And the king of all solvency ratios, the one you will definitely see in your exam beta, is the debt-to-equity ratio. The name says it all, right? It just compares the company's long-term debt, that's money borrowed from outside, to its equity, which is the owner's own money invested in the business. Let's make this super simple. Equity is the ghar ka paisa, the owner's own money. Debt is bahar ka paisa, borrowed money. Now you tell me, which is more risky? The borrowed money, of course. You have to pay it back, with interest, whether you make a profit or not. The more of your own money you have in the business, the safer and more secure it is. Okay, let's go back to our patient. The data from illustration 7 shows us long-term debts are 5 lakh rupees and the owner's equity is 15 lakh rupees. Simple numbers, let's put them in the formula.
And the ratio is 0.33:1. Wow, this is a fantastic report. What does it mean? It means for every 1 rupee of the owner's own money, the company has borrowed only 33 paise for the long run. That's so safe. It shows the company depends on itself, not on outsiders. The doctor is very happy. This patient has very strong financial bones.
Okay, we've learned the theory. Now it's time for some real-world action. Let's solve a proper case, just like one you'd get in your exam. These are the tricky questions that check if you really understand the concept. Ready to put your brains to the test? Let's do it. All right, here's the puzzle from illustration 6. A company's current ratio is a perfect 2:1. Now listen carefully. It pays a current liability of 10,000 rupees. So what happens to the ratio? Does it go up, improve? Does it go down, reduce? Or does it not change at all? Take a second. Think. This is where a lot of students make a mistake. Okay, let's solve this mystery together. A 2:1 ratio could mean anything, right? So let's just assume some easy numbers. Let's say current assets were 50,000 rupees and current liabilities were 25,000. That gives us 2:1. Perfect. Now the company pays $10,000. What happens? Well, cash, which is an asset, goes down by 10,000. But the liability, the bill it paid, also goes down by 10,000. So both numbers decrease. Our new assets are 40,000 and new liabilities are 15,000. Now let's calculate the new ratio. 40,000 divided by 15,000 is 2.67:1. Look at that! The ratio has improved! I know it feels strange, but the math proves it. And now you know the secret. We've done the checkup, we've solved the tricky case. Our work as doctors is almost done. But before you leave the clinic, every good doctor gives some final advice, a word of caution. Ratios are wonderful, but they are not a magic wand. They have their limits.
And it's so important to remember this, Bajo. First, if the accounting data itself is wrong, your ratio will be wrong. Garbage in, garbage out. They also don't consider price changes from inflation. But the biggest thing is, ratios are all about numbers. They can't tell you if the manager is smart, if the customers are loyal, or if the brand is famous. These are things that don't have a number. So always use ratios as the first step in your investigation, never the last word.
So, my dear students, please remember this. Don't just mug up the formulas. Try to understand the story behind the numbers. That's where the real learning is. You are all so smart, and I know you can do this. You've got this. Prepare well, don't forget to take breaks, and walk into that exam hall like a champion. All the very, very best from me.